Chapter 6, we're going to talk about payroll. So the first section deals with just calculating your gross wages and salaries. So if most of you probably have a job or have had a job in your past, if you're just paid hourly, that's kind of the one of the easier methods. So you're just going to take the hours you worked times your hourly rate of pay, and that gives you your gross earnings. If you're working full time and you're in an environment that maybe during like the busy season you're going to work overtime, then anything over 40 hours a week, you have to get paid time and a half. Again, assuming you're an hourly worker, not a salary worker. But so you calculate your overtime hours, again, anything over the 40 hours, times the hourly rate times 1.5. So that 1.5 will give you time and a half. So that's the easiest way to do that. Now, if you are a salaried worker that does get overtime, so sometimes say like nurses or police, maybe on salary, but they still will get overtime if they work over 40 hours, will have to take their salary, divide it by whatever their normal work week is to get an hourly rate, and then we can pay them the overtime, that the hours worked over 40 times the hourly rate times 1.5. So here we have an example. If we've got 50 hours at $10 an hour, those first 40 will be regular pay. So $40 times $10 gives us $400. Then the 10 hours over 40 are overtime. So times 10 times 1.5 gives us our time and a half at $150. So then the total pay is those two added together, our regular pay plus our overtime pay. Now, sometimes if you're on salary, so say you graduate and they hire you in as a supervisor or a manager, you may be on a salary instead of being hourly. So then they'll tell you, hey, this is your annual salary. And then if you want to figure out, well, what am I actually going to get per pay? You need to take that and divide it by how many times you get paid a year. So if you're weekly, you get paid 52 times a year. If you're bi-weekly, which a lot of companies are, I feel like that's probably the most common. It's like every other Friday. Then you get paid 26 times a year. If it's monthly, it's 12 times. Sometimes semi-monthly is also common, and it's like the 1st and the 15th, or the 15th and the last day of the month. Then you'll get paid obviously twice a month, which would be 24 times. So what I always do is no matter what they give me, if they tell me this is your weekly pay or this is your biweekly pay and they want to know what the other equivalent earnings are, I always go figure out, well, what's my annual salary? Then once I have my annual salary, then I'll go back and divide it by all the, the times that are listed above to get to the other ones. One thing that students will make the mistake of is say they give you like the monthly salary. They'll divide it by 4 to get to the weekly. And that's not true. So if that were true, we would have 48 weeks in a year, and we don't. We've got 52 weeks. So you can't oversimplify. So here we have an example. So if your monthly salary is $2,000, what would your weekly salary be? Again, so like this is an example of ones that students would say, okay, I'll just divide it by 4. And that's not correct. So what I do is I take it and I multiply it by 12 to get it into an annual salary of $24,000. Then I'm going to divide it by 52 to get to the weekly salary. Then I would divide it by 26 to get to the biweekly. Then I would divide it by 24 to get to the semi-monthly. I would divide it by 12. Well, no, they already gave me the monthly. I started with the monthly, so I'm good. But so you just that's how I always do it. First get it into the annual and then go from there, because that's the easiest way to just kind of remember how to calculate those. Then we get into piecework. So say if you are a truck driver, or if you're if you work in a manufacturing environment, sometimes you're paid per piece, or a farm, you're picking blueberries or something like that, you'll get paid per blueberry. So say you have that type of a job, you'll get paid by your production level. So like my example is a truck driver, if they're paid per mile, and they drive 520 miles and they're getting paid 43 cents a mile, they're going to get $223.60 for that day. Or maybe you're a car mechanic and you get paid an hourly rate, or you get paid a piecework rate, whichever is higher. So say then that compensates you for those busy days, you're going to get paid extra, but then those slow days you'll go back just to getting your 10.50 an hour. So a lot of times service industries do that. So say you have a day where you install 36 tires and you get paid $3.20 a tire, you're going to make $115.20 that day versus 8 hours times 10.50, which is only $84 a day. But then maybe say another time you're real slow and you only change 20 tires, that's $64 you would get paid for your 8 hours at 10.50. So you kind of have to look at each day to figure out what is going to be their total pay for that week. And then that you can also have overtime, and then what that is just any of your piecework that happens after the 8 hours or the 40 hours a week, you're going to get paid that piecework rate times the 1.5. So kind of the same computation as above, except for you would just multiply it by 1.5 if it was after the 40 hours. Then we get into commission. So say you're in sales, whether it's retail sales, real estate, real estate agents are straight commission. If you work in a car sales place, you may get a salary plus a commission. So it again depends on where you work. But the straight commission, so say you're that real estate agent, it's going to just be the selling price, the sales price of the house, times whatever the commission rate is, and that's how much you're going to get paid. If you work in retail sales, they're always going to subtract out your returns. So whatever your sales are minus whatever returns have come back, then multiply that by your commission rate for that pay. Then we can have times where you're on a variable commission. So the assumption there is that for those first sales, you're not going to get as much and sometimes the first step of the variable commission is actually zero. So you don't get any commission on your first so many sales because they are assuming, even if you're a horrible salesperson, people will still come in and buy stuff. So then they reward you for going more than that, go above and beyond and try to add on and get more sales. So they give you, again, incentive to get those more sales. So if we look at the tier, the first 10,000 of sales, she's going to get paid 6%. The next 10,000, so up to 20,000, so from 10,000 to 20,000, she's going to get paid 8%. Then all sales over 20,000, she'll get the 9%. So then you got to tier it out to say, okay, if she has $32,768 in her personal sales, again, the first 10,000 get the 6%, so $600. The next 10,000, which again takes her up to 20, she'll get $800 for that. Then how much is she over the 20,000? She's 12,768 over the 20,000. So that she would get 9% on. Then you're going to add all those up for her total pay. Then you can have some different terminology in these commission problems. So obviously commission is our sales times our commission rate. There could be quotas. So that's kind of what I was describing on that last slide. The quota is saying that this is the amount of sales that's basically required for your job and you will not be paid commission on them. So you're going to take your sales and then subtract out that quota, and then that net amount times your commission rate is how much commission you'll get. Excuse me. The salary is what you would get paid in addition to your commission. So like say you're a car salesman, you're going to get a salary because there's going to be weeks that you don't have any sales, especially in Ohio when it's bad weather. People aren't out there buying cars. So you would just get your salary and then whatever commission you did earn. Now a draw is an advance of the commission. So say you're going to get your commission check at the end of the month. Well, maybe on the 15th of the month, they'll give you a draw, like $500. But then when you get that commission check, they're going to subtract that draw out. So they're just kind of giving you an advance on that commission check so that you actually have 2 checks a year, 2 checks a month. Okay, then we get into Social Security and Medicare tax. And I think that this is relevant just because it's withheld out of everybody's paycheck. So you got to kind of understand what that is. So they call them FICA taxes, but they were set up, I don't know, like probably in the 1940s or 30s or something, to help provide for income for our retired or our elderly citizens. So if people didn't save, they would basically be homeless. So the government stepped in and said, okay, well, we will set aside money out of everybody's paycheck to help provide for when they're retired. So it covers our Social Security, which is a payment to the older people, as well as Medicare, which is insurance for the older people. So how that works is every paycheck that you get will have 6.2% withheld for Social Security, and then your employer also pays that 6.2% on your behalf. So a total of 12.4% is going into Social Security every year for every employee, up to a maximum. So this textbook again has a little bit older tables in it, so it goes back to 2017. But every year that maximum goes up a little bit, just due to inflation. So in 2017 it was 127,700. I think it's in the 130,000s now. Then now Medicare is 1.45% paid by each employee and then matched by the employer, so that total going in for each employee is 2.9%, and there is no maximum. So even if you make $500,000 a year, you're the president of the company, you're going to be paying 1.45% of that entire amount into Medicare. So this does build, as long as you've worked for 10 years and paid into Social Security, you do get a Social Security check when you retire. So, again, a lot of people are kind of counting on that. We watch the government shut down and we worry about those things, but I feel like it's being paid into, and as the older population that is full of baby boomers kind of goes down, I think we'll see our Social Security systems go back up. And like I said, your employer pays half and you pay half. So what if you're self-employed? Well, then you're both. You're the employer and the employee, so you're going to pay those totals. You would pay 12.4% into Social Security and 2.9% into Medicare. So that's a little bit bummer for self-employed people, as they do have to cover both sides of that. Companies also have to pay into like workers' comp type programs, which is like the state disability insurance. And that might be a certain percentage. This textbook likes to use 1% of the first $31,800 in wages. Again, that could change. That's just an example. That could change depending on the state and depending on the person. So just read those carefully to see what's coming out. Okay, so that is our payroll chapter.